Fineman is co-head of equity strategy at Asia Pacific at Credit Suisse. He's joining us right now. Dan, good to have you with us here. Thanks very much for your time. Are you still maintaining your overall sort of cautious stance? We got a cut last night, Dan. Let's just start with the data. Home sales numbers were very strong. Consumer confidence was very weak at a 9-month low. How do you square both of those? And what should we expect? What will the Fed pick up on next week when they meet to make the decision?
Well, I think it's not unusual to see mixed data when you're at a transition point for the economy. We're not in full speed ahead mode. We're not in recession yet. We're shifting into a slower growth mode. And the first thing you would be seeing is mixed data signals. That's perfectly in keeping with our expectations that the economy in the U.S. will be slipping into recession this year.
Dan, hi, good morning. So, that seems to be the base case now, that the U.S. is going to be slipping into a recession. But for most markets, including emerging markets like India, there's some semblance of sanity that has returned. After a steep fall last year, this year the market is sort of clawing back a tad bit. Do you think now valuations are ripe for investing into a market like India?
Well, India in particular remains on the expensive side. India has been very expensive, even by its own standards, for 2 years now. It's given up quite a bit of that valuation premium, but it's still an expensive market relative to its own history, relative to the rest of the region. The rest of Asia, however, I think is looking much more appealing. North Asia is clearly cheap. There are some markets in Southeast Asia that are cheap. In general, emerging markets globally, I think, are good value. This is in contrast to the U.S., which still doesn't look cheap to us.
All right. Hi, Dan. I think the last time we spoke as well, you mentioned that you prefer emerging markets in comparison to the U.S. markets, and I think you're holding on to that thought. But it appears because of valuations, India is not really up there as of now. Two-part question, though, I want to ask you about the global markets. One is, what kind of hikes are you working with? It appears 25 basis point is almost a done deal for May. But post that, are you seeing a pause, a pivot at some point of time, a cut later this year? And also the banking crisis in U.S., every now and then we're getting some bit of jitters. Is that a cause of worry, or do you think that'll be taken care of?
I'm having trouble with audio. If the producers could turn up the volume, that would be helpful. Let me answer your first question.
Let me try again.
Okay.
Yeah, Dan, let me try again. One point I wanted to understand was on the Fed rate hike trajectory and if there's a cut in store. And the second point is about the banking crisis. Every now and then we're hearing about a U.S. bank looking a little bit jittery. Go ahead.
Okay, I'm still having trouble with audio, but I think I catch the gist of your questions. First of all, on the rates issue, I think that we are more likely to see a pause rather than a full-on pivot where the Fed cuts rates. The Fed does have other tools at its disposal to deal with the banking situation, aside from cutting interest rates. The markets have consistently underestimated how hawkish the Fed would be. I think that trend will continue and that markets will be disappointed if they're expecting a pivot. As far as the banking crisis is concerned, as I say, I think the Fed has other tools at its disposal to deal with that. It won't have to use monetary policy. That is not going to be its favored tool. It can engineer a rescue handled by other big banks. It could wind it up as it did with Silicon Valley Bank and have the government take it over. But I think that its last option of choice would be to use monetary policy to prop up the banking system.
Dan, any specific views on India, emerging markets, what global funds are positioned like right now?
Well, funds have, I think, gone more towards a neutral position. Global funds have gone more towards a neutral position in India. You go back to 2021, they were heavily overweight. Then last year they sold down. This year, I think they're sitting at more of a neutral position. They like the underlying economic story, but not entirely comfortable with the valuations even now.
All right, Dan, we leave it at that. Thanks a lot for stopping by and speaking with CNBC TV18. Appreciate your thoughts. So that's the word on the global market, but we have to take a short break because there's so many stocks to discuss locally. Bajaj Auto, Tata Consumer, Maruti comes out with numbers today. SKP IT Tech's earnings